You are listening Cryptoassets by Burniske and Tatar. Digital currencies dominate today's financial headlines, sparking heated debates across investment circles. Skeptics dismiss these innovations as fleeting trends destined for failure. Champions argue we're witnessing finance's revolutionary transformation. Both camps miss crucial nuances that smart investors recognize. Understanding what makes these assets unique becomes essential for anyone navigating modern investment landscapes. We're not talking about traditional commodities or typical currencies. These represent something entirely new: hybrid assets combining software functionality with monetary properties. Consider how Bitcoin operates differently from conventional investments. Traditional assets like gold serve as stores of value because people universally recognize their worth. Oil functions as a consumable resource that transforms into other products. Bitcoin merges both characteristics while adding programmable functionality through its underlying software. This dual nature creates unprecedented investment opportunities. Smart money recognizes that successful digital assets must excel at multiple functions, storing value while providing practical utility. Those meeting both criteria will likely dominate tomorrow's financial ecosystem. The revolutionary technology powering these assets deserves deeper examination. Blockchain networks function as massive, distributed databases, tracking ownership without central authorities. Unlike traditional banking systems controlled by governments or corporations, these networks operate through millions of connected computers worldwide. Think of blockchain as an incorruptible ledger that everyone can verify, but nobody can manipulate alone. Every transaction gets recorded permanently across countless computers, making fraud nearly impossible. When you try to cheat the system, millions of other computers immediately detect the discrepancy. This decentralized approach eliminates single points of failure. Traditional banks can freeze accounts, manipulate records, or collapse entirely. Blockchain networks continue operating regardless of individual component failures. That resilience attracted early adopters seeking alternatives to conventional financial institutions. Bitcoin's mysterious origins add intrigue to its revolutionary story. Its creator, known only as Satoshi Nakamoto, remains anonymous even today. Some believe multiple people collaborated under this pseudonym. Bitcoin launched on Halloween 2008, precisely when traditional financial systems were collapsing spectacularly. This timing wasn't coincidental. Global frustration with banking institutions created perfect conditions for alternative systems. People desperately wanted solutions that didn't rely on trust in fallible institutions. Bitcoin offered mathematical certainty instead of blind faith in central authorities. Other digital assets followed different paths while sharing core principles. Ethereum expanded beyond simple transactions to enable collaborative software development. Its blockchain hosts entire applications, not just financial records. Privacy-focused alternatives like Monero and Zcash use restricted access networks for enhanced confidentiality. Financial institutions increasingly adopt private blockchain networks to capture efficiency benefits while maintaining operational control. These hybrid approaches demonstrate the technology's flexibility across different use cases. Why should traditional investors consider these emerging assets? Historical precedent suggests we're witnessing a transformation comparable to the Internet revolution. Early email adopters gained massive advantages over competitors stuck with postal mail. Similarly, blockchain technology may eventually replace centralized banking infrastructure entirely. Bitcoin's maturation offers encouraging signals for cautious investors. Extreme price volatility has decreased significantly since its early days. While you won't see the explosive returns that early adopters enjoyed, you also face reduced risk of catastrophic losses. Mainstream adoption continues accelerating as businesses integrate digital payment systems. Growing acceptance will drive demand higher, potentially increasing prices substantially. Newer assets like Ethereum remain more volatile as their support systems mature. However, serious risks accompany these opportunities. Crowd speculation creates dangerous bubbles when inexperienced investors follow trends without understanding underlying value. Professional speculators exploit these situations, buying low and selling high while amateurs lose significant money. The "this time is different" mentality presents another hazard. Some investors believe traditional market rules don't apply to new asset classes. While digital assets do operate differently, fundamental investment principles remain relevant. Thorough research and rational analysis matter more than ever. Smart portfolio construction requires understanding correlation patterns between different assets. Traditional stocks and bonds move in opposite directions during economic cycles. When economies boom, investors favor stocks over bonds. During downturns, bonds provide safety while stocks decline. Digital assets typically show zero correlation with traditional markets. This independence offers powerful diversification benefits. When traditional investments struggle, your digital holdings may remain stable or even appreciate as frustrated investors seek alternatives. Getting started requires opening accounts with reputable exchanges like Bitstamp or GDAX. Most platforms currently accept only Bitcoin and Ethereum for direct purchase, using government currencies. Once you own these primary assets, you can trade them for virtually any other digital currency. The speed of digital transactions provides major advantages over traditional banking. While bank transfers take days to clear, digital currencies move instantly across any internet connection. This efficiency makes them ideal for rapid trading or international transfers. Before investing, evaluate each asset's trading pair diversity. Robust digital assets trade against multiple government currencies and other digital assets. Higher diversity indicates stronger market support and improved liquidity. Secure storage becomes critical once you've made purchases. You'll face a fundamental trade-off between accessibility and security. Hot wallets maintain internet connections for easy access, but expose you to hacking risks. Cold storage devices remain offline for maximum security, but limit quick access. Most exchanges offer hybrid storage combining both approaches. Third-party services like Coinbase provide professional security while maintaining reasonable accessibility. Research each platform's security track record before trusting them with significant assets. Sophisticated investors look beyond simple price analysis when evaluating opportunities. White papers reveal each project's technical approach, competitive advantages, and implementation details. Quality documentation shows clear thinking and professional development practices. Assess each project's decentralization benefits. Truly valuable digital assets solve real problems that centralized solutions can't address efficiently. Swarm City demonstrates this principle by enabling direct peer-to-peer transactions without corporate intermediaries taking percentage cuts. Examine the communities supporting different projects. Strong digital assets attract experienced developers, engaged miners, and committed investors. These communities provide ongoing support that drives long-term success. Fair distribution models ensure healthy asset ecosystems. Avoid projects that concentrate excessive power among developers or early miners. Such concentration creates dangerous dependencies on small groups, whose decisions affect all other investors. Supply mechanics also influence long-term value. Excessive initial supplies dilute individual ownership and suppress price appreciation. Look for reasonable supply limits that balance availability with scarcity. The investment landscape offers unprecedented opportunities for prepared individuals. Digital assets represent the kind of transformative technology that creates generational wealth for early adopters. However, success requires thorough preparation, careful analysis, and appropriate risk management. Educational investment distinguishes winners from losers in this emerging market. Study white papers thoroughly. Understand correlation benefits. Evaluate storage options carefully. Most importantly, never invest money you cannot afford to lose entirely. The future belongs to those who recognize revolutionary change while managing associated risks intelligently. Digital assets may transform global finance as dramatically as the internet revolutionized communication. Position yourself appropriately, but always with full awareness of potential consequences. Found these insights valuable? Hit like and subscribe for book summaries that could transform your thinking. The purchase link for Cryptoassets is waiting in the description, and we're curious, which of these concepts resonated most with you? Drop a comment below.